can see that at the bottom of the edge here, we started to see the dispersion traders coming in. This is like the second level quality dispersion trader coming in, buying the bottom edge. And obviously it's up to you whether you're trading NASDAQ or S&P. They can be a little bit of a crossover on these trades, of course, and that's something that we pay attention to. So we obviously just acknowledge the crossover. That doesn't always play out the same in every example, but we still acknowledge the crossover. And when you're looking at the NASDAQ, of course, you're looking at volumes, you're looking at all sorts of other things as well as. But let's take a look anyway and see what... we'll put that over here and we'll bring this across, actually. Make it a little bit easier for me. So let's take a look at the framework of some of these trades from 1430. And you can see at the beginning of the day, we started to see some sell-side algorithms. Sell-side algorithms kicking off at the beginning of the day, 1431. Now, that's a sell momentum trade. So 1430.31 is this candle here, okay? So when you've got a sell algorithm, a max sell trigger coming in from one of these HFT programs, they're not going to trigger unless the price drops. It's not a sell on the way up. It's a sell on the way back down again. So if you don't have order flow, the way to deal with this is just do candle reversals. So when that candle closes there, you're obviously going to sell when it breaks here. When this candle closes here, that you're going to sell on the break there. So that would have been your first trade of the day on the NASDAQ, as a sell there. That would have been your first trade. Okay. So once we've got those sell triggers coming in, you can see that we get that at 1431 from all three of them. We get a volt sell, we get a max sell, and we get a HFT short. Then what happens? 1433, we start seeing option dispersion hedgers looking to bid into aggregate volume. So in other words, volume is a key component here, 1433s. Let's find the 1433 candle. This is the 1433 candle, is this green candle. Now, we know that these dispersion hedgers are buyers of bottom edges. So we simply then draw a line against that price. And we put ourselves on bid watch into the low following that candle close there. Yes? So what happens next? 1433, we get a buy trigger starting to come in again. So markets are already starting to go up. So we want to see a red candle for this to take place. NASDAQ. This is one of the very specific NASDAQ triggers. 1433, same candle. NASDAQ futures bids expected from the number 2 trade, which is the option fund hedger. Option fund hedger. So now we're looking at this and we're saying, well, we're now getting a lot of different buyers into the low price. Not just one. We've now got dispersion hedgers coming in the S&P, and now we've got option fund hedgers coming in the NASDAQ, all within 2 minutes of each other. That's pretty good, right? That's pretty good. It got a little bit better when we started to see this trigger here. The S&P is now expecting to see the max strong bid coming in from the dispersion hedge activity. It's also at 1433. So it's exactly the same trade again. It's that same liquidity pool to get that option hedge. Then we get a max buy trigger at 1433, which obviously is that momentum buy trade. So now we know that they're likely to buy the break higher. It makes life a lot easier to buy the bottom edge. Does that make sense? If you get a max sell program, that's a sell at lower prices. So if we sell higher prices on a dispersion trade, that's good news because we know that the momentum algorithms are going to be selling below us. So when we come into this area here and we start seeing a volt buy trigger at 1433, and we see a max buy trigger at 1433, and we see an HFT buy program at 1433, we now have bids above this price. Okay, we've now got bids above this price, not offers. And if we can put bids above that price, life for us as a bottom line trader is becoming a lot easier. The challenge you've always got about trying to buy a bottom edge is that you don't have any evidence of a buyer at higher prices. We've just been told about buyers at higher prices here. Buy programs. There's another buy program and there's another buy program all resting at that top line price. So when the price then sweeps into the bottom edge, and we're getting max buy programs from dispersions, and we're getting option hedge fund buyers, we're now looking at this and saying, this looks like a banker buy trade. Looks like a banker buy trade. Turned out to be a banker buy trade, didn't it? The price went off the 788s. We've obviously got an idea that we'll probably start seeing some commercial activity into this price, and we start looking for that commercial activity. All good? So we get the same thing happening. Dispersion hedgers, option funds, market makers start adding bids into discount prices at 35. So now we know that everybody is long. Everybody's now long into this bottom edge. Everybody's bought into the bottom edge. And because of the trade log, we had the earliest read on that across the industry. With buyers at higher prices, bottom edges become safer. This is why when you've got simply just the bids at the bottom edge, but you haven't got any evidence that there's going to be a buyer at higher prices, you'll probably buy and it'll go up a little bit and it'll drop a little bit more, and then you'll buy again and it'll go up a little bit and it'll drop a little bit more. And it just keeps going that way until you get a little bit bored or your execution's so poor that you're losing money. Well, we need to fix that. We need to fix that as traders, and we need to fix it kind of quickly. Makes life a little bit easier, doesn't it? Makes life a little bit tastier if we can put those two pieces of the jigsaw puzzle together at the same time. So let's see how this trade eventually developed. So we get a breakaway, we get a sell program followed by a buy program. Remember, a sell program is a sell of a green candle. 1438. So let's find 1438. So 1437 is that spinner candle. So a sell program, you'd imagine, is going to kick in probably below the last green candle. And then we get a buy program at 1439. So that's the 1438 candle. The 1438 candle is this candle here. So we know that we're probably going to get a buy program if it breaks above that price. Well, that's exactly where the buy program kicked in, wasn't it? So you got an opportunity to buy for the press right there. Agreed? It became effectively a BSG squeeze. So that buy program became a BSG squeeze. Remember, the buy program kicks in. You might say, but surely that would have been a brilliant opportunity to buy the 1439 candle, which would have been this candle here. Surely that was where the buy candle was, and that's where you should buy it. Remember, this is an HFT buy. This is a buy when the momentum swings for the buy trade outcomes. So we don't really want to take advantage of that trade until it starts going back up, which is why we suggest that you use the candle reversal as a way of looking at it, or if you've got order flow tools, to start using delta leans. Another buy program, 1444. So at 1444, another buy program. There's the 1443 candle there, see it? So we've got buyers up here, haven't we? Yeah. It's not the biggest buy program. It's probably the least important buy program, but we've got buyers up there as well. So that's good news. Okay, so we move on. We've got an Australian dollar bid watch. Now that's actually quite a useful piece of information, because obviously a bid watch on Aussie dollar is a positive equity type, positive beta type situation, isn't it? So that's actually not a bad thing, considering that we're now long into these two trades. And an Australian dollar bid watch at 1445 is giving you a little bit of confidence. There's 1445 right there. If we'd obviously got a buy program, we could have taken advantage of the sweep there, but obviously the buy program was some time ago, and you'd have hoped to have got another one, but we didn't get one, right? And then with 1447, we start recognizing this trade here. Futures offers against dispersion trades. It's the weakest one, but we still recognize it. 1447. 1447 is that candle there. Right, so there's the 1447 candle right there. 1446 and 30 seconds. That's the candle that closes at 1447 when this information comes onto your charts. If you're long, you haven't seen a seller at bottom edges, have you? Have you got any sell programs in here? No, there's no sell programs in there. The sell program was some distance away. So when we're looking at this as a top line, we really are recognizing that it is a top line. So therefore, if we're going to sell it, we need to make sure we really get that premium price into that sell. Agreed? And if you don't like it enough, you simply use that sell as your profit-taking opportunity. Well, guess what, guys? Using the trade log, could you have quite easily have bottom ticked the price and top ticked the price with the correct buy in the middle? So when we look at this as a process and you recognize that that was also the measured move, you're starting to get a few clues about this cash open now, aren't you? You're starting to learn a little bit about these concepts. You're starting to learn about the passive nature of that top edge because we haven't got sellers at lower prices. So we know it's going to be a right shit fest up here, right? The sell is going to probably be a bit of a nothing burger at the top edge. It's going to be a little bit of a challenge to get any real action developing off it. So we've got to be really, really passive at the top edge until we start seeing some sellers at bottom lines, until we start seeing some more confidence from the prop type traders. So for that reason, this outcome is not a surprise. It's not a surprise at all. We've just been discussing it before the price went up. So you're able to now look at it and say, well, I can guarantee that there's going to be more commercial interest. And at the top edge again, we can start looking for that same play again into the top edge. But now we've got what's called a capper price. So we can mark off this area here and we can call it a cap buy trade. If you want to do it a little bit more aggressively, you can obviously do it more aggressively or a little less aggressively. You can do it down here. So with the cap buy trade in place, you're now looking at it and saying, well, according to what I'm seeing, I'm thinking that this could be a basic commercial structure going forward. Looking at the timing, we can now recognize the timing is going to take us into the big exit price time level of 1500 hours. And that gives us an idea about this trade now, doesn't it? It gives us a process that we can now look at and say, well, realistically, it could look a little bit like that, couldn't it? All right. So we can start to recognize the process behind this. So when we see this as a process and we start understanding the process, we can start looking at trying to develop out the ideas. Now, remember, it's not trades, it's ideas. If it was trades, it'd be specific. Buy at this price, sell at this price. This is where the trade is. This is what we're doing. It's not that. It's looking for the process to develop into this area. It's looking for the process to develop into these areas. It's learning and understanding about that sell press. It's learning and understanding about what this bottom edge is. And this bottom edge was interesting because we've obviously got this bottom edge here as well. And this is what we're starting to recognize. The bottom edge, the stories, the process. The top edge, the stories, the process. If we don't recognize the pricing, we can't ever find this bottom edge. If we don't recognize the pricing up here, we can't price it properly to find the top edge. And the trade log would be as much use as a chocolate ashtray. So we've got to make sure we learn this process so that we can learn how to use things like offer watches and bid watches properly. Without that process, we might as well chuck it in the bin. So this is the important aspect of trading, isn't it? It's about fitting the narrative together. And if we can fit the narrative together, I asked a question a while ago. So when I'm on bid watch, what would everybody think to do? And the answer was buy it. And the answer is no, you're all wrong. It's sell it. Bid watch is predominantly an idea that we're going to be buying it for the press. No, we're going to be selling it for the press. Everybody thinks buy when they see bid watch. It's sell when you see bid watch. And once we've got the press into those passive liquidity areas, then we can start considering the trade outcome, can't we? So when we get this idea of gold offer watch, can almost guarantee the gold price will be going up, not down. So when you understand that, you can start to look at that and say, well, I know that that's likely to happen. So when you saw gold offer watch, what would my natural trade be? To buy it. Let's take a look and see if that buy would have made any money. 1451, 1452, bid watch. So I would buy it. I would buy it. Sorry. So when we're looking at these as ideas, we have to put it into context. See how gold is offer watch? Gold is offer watch. That is going to be probably a buy on gold at the first start. And there's the buy on gold. If you didn't know that, would you have bought it or sold it? Gold offer watch? You'd have tried to sell it, wouldn't you? And you would now be losing a lot of money and you'd be moaning at us that it doesn't work. Well, because you haven't listened to a thing we've said, because you haven't understood the process. So when we understand the process, life becomes a little bit easier. We look into the background and we say, how can that be an offer watch? There's no price levels. So we start looking for where the liquidity is, for example, and we start saying, okay, well, if gold's got an offer watch, that's going to be the price level I'm interested up here. That's where the liquidity pool is. That's where the flush is. And if we get into that area, I'll look for more offer watch opportunities. More offer watch opportunities. And as I get more offer watch opportunities, I start watching for the offer coming in. And that bid that I took against the offer watch has just paid out nearly $300 profit. If you don't understand that, you can't use it. It's as simple as that, right? You cannot use it. It has as much use as a chocolate ashtray. So therefore, this is why this process is so important. This is why we've got to make sure everybody understands this before we can do anything with this, because nobody seems to be understanding it yet properly 100%. Some of you will. But it's going to be nearly impossible for us to gauge that until we start seeing the positive responses to things like this. When we see a bid watch, we sell it for that bid. When we see an offer watch, we buy it for that offer. And that's as simple as it gets. It's as simple as it gets. We've already told you about this because we've got these offer watches. We told you that this would be what the price would do. Guess what? That's exactly what the price has been doing. If you didn't know that and you looked at that and you says offer watch, and you looked at that and you said offer watch, you'd have been thinking to yourself, I'm going to sell it. You wouldn't have learned a thing that we've been talking about, would you? You've learned nothing. So what we've got to recognize is that that's what an offer watch looks like. It's not a sell. It's an offer watch, which means it's going to be a higher price, which means that it's a better buy opportunity. It's going to be a better buy opportunity for the equities. For the press, I'm not saying it's going to be a big commercial buy trade, but what I'm saying is it's going to be a buy opportunity for the press. And then we'll get more information about the press, because what should happen is it should get better and better. We should start seeing some algorithmic short sellers coming in. We should start seeing some ideas about those arbitrage sell opportunities. We should start seeing some other things coming into the screens as well. Bond sellers, for example, would be a useful thing to start seeing, coming into those as storylines. Otherwise, we just draw the line. And if we draw the line, look at what happened against the line. Massive volume came in. We've just managed to sweep the 1480s, the 890s, sorry, not the 880s. So we can see the 890s has just been swept. Obviously, the big liquidity is at 14,900. And obviously, that's the target price that we would imagine that they would be doing. We said it would probably start developing up to 1,500 hours. So the timing becomes incredibly valuable to us as well, doesn't it? But what's exciting about this, Reeve? What's the most exciting thing about this? I told you that that's what was going to happen before it happened. We drew that line in before it made the higher highs. And that's from an offer watch, Tom. Not a bid watch, an offer watch. If you miss that process, you've sold it, you've sold it, you've sold it, and you've sold it, and you've sold it, and you're all moaning your faces off. It never went down. It says, was it an offer or was it an offer watch? It was an offer watch, right? So the price should go up. That's why you're looking for that offer. You're trying to find that liquidity pool. You're trying to find those liquidity areas. You're trying to find those flushes, just like the commercials are. And you need to figure that out before you'll start to see that trade evolving. And then, only then, do we start recognizing that there may be something quite exciting about to brew. Now we're getting a sell program at lower prices. So you're now seeing some good signs about this, aren't you? You're now seeing a sell program coming in here at lower prices. So this is good news. So obviously we're thinking that there's going to be some sellers down here. And as we start to recognize the fact that there's going to be some offers at the bottom edge, and that's going to start making the top edge that little bit better. Remember what happened to these bids here? It made the bottom edge better. With the offers here, it's going to make the top edge better. And that might actually line up perfectly with this, perhaps, this liquidity sweep. So we draw in these liquidity pool levels, and we draw in these liquidity pool levels, and we look for that as an opportunity to deal into those liquidity pool levels. And then what do we look for? We start looking for that offer opportunity. We start generating that piece of information that builds. We start looking at the deltas. We start looking at perhaps an overbought delta, an oversold delta. We start reading the tape. We start adding the tape excuses into the narrative. I've got an excuse to sell it because there's too many buyers. I've got an excuse to buy it now because everybody's short selling. And that's why today's classroom is going to be on the market maker's game. Recognizing what the market maker inventory position is, recognizing what the market maker is likely to do with it, and then being able to spot as early a sign as possible that the market maker is actually doing something with that liquidity. And this is what we start to use. We start to use those leans, 2-tick stops, 3-tick stops. We start to get involved in those kind of trades. Life becomes that little bit better, that little bit easier. Euro Swiss is still dropping. It's done pretty good. I say pretty good, guys. 10 pips, but that's normal for Euro Swiss. 10 pips is as good as it normally gets. The short oil's done well. $88.80 down to 10s for 700. So that little short sell on oil has done very good for your money. Obviously, we've taken the cash open price and it's gone offered against that. You can see it's pinned here, it's pinned here, and it's pinned here. And we can recognize that $90.50 area really has given us a very strong case to get that short sell in place. Remember, that was against a bond short, which obviously the bond short did okay. I mean, the bond short was in pretty good shape at 15, 16s, traded a low price of 6s. So when it trades the low price of 6s and it bounces back up to a scratch at break evens, you've now got the opportunity to scratch out the bond and leave your oil short play in place, and that's now making a lot of monies. It lines up with everything else. It seemed to still be okay at this stage, a little bit cheeky, but I think elsewhere we've seen some signs that seems to be on the face of it okay. The trade, of course, that seemed to become very, very obvious was this trade here. Interestingly enough, that trade there is the short sell in equities. That's the short sell in equities. So when we see the short sell in equities coming in there, especially something like the NASDAQ, which is going to be very, very interesting from that as a real yield point of view. So you can obviously start looking at the NASDAQ as a possible short sell into that, and that's obviously the equity position that we've just been discussing. You can see that sell has played out exactly as we thought. It came in after the 3 o'clock here. The sell has came in as we expected. It's traded out almost exactly the way we thought it would. When the offers came in, you can see that the offers have now driven the price away from that liquidity pool at the top edge. It's almost textbook. It's almost worked out textbook. Ran the liquidity, came off the 90s. We said it's going to mark down, one would imagine, at 3 o'clock. It's now marked down at 3 o'clock, which means that we've been on this trade perfectly well since the get-go. We had an HFT sale program that also backed up that one there a minute or 2 minutes later. So we had offers there, and we had an offer just a little bit higher still. We had offers into that phase there as well. So with those offers in place, the timing seems right. The timing seems appropriate. The timing seems to be the right thing to do at that point. And obviously the takeaway from that trade was okay. You've went from a high price of 890s to a low price of 850s. 40 points is worth about an $800 swing. Or if you took the pullback into this liquidity pool at 80s down to 50s for 30 points and a $600 swing. Whatever you did, you had the timing right, you had the play right, you had the structure of the trade correct, the capper's idea was spot on, the process in this area was spot on. It's just a perfect example, isn't it? But it takes a bit of work. It takes a bit of work into this. But we've got to try and think about these as processes. We've got to think about the idea of an accumulation term. How long is it going to take? When are we going to get the XE coming out? When are we going to see the XE appearing? When is the XE going to be visible? So when we think about that as a process, this is a benchmark example, isn't it? Benchmark example.